Hi, my name is Yasha and I help young men invest in the stock market. Now today we are going to analyze this company called Equitrans Midstream Corporation with the stock ticker ETRN. Because you asked for it, you asked me if I can analyze it and help you decide whether you should also invest in this stock or not. So here we are, okay? Of course I will help you, man. Now, as always, we are going to analyze Equitrans using this little Canva presentation that I have right now here. So let's begin, okay? First of all, why should you even listen to me? My name is Yasha, as you know, and I help young men invest in the stock market so that they can actually make some money with it. And if you are interested in that, click the first link in the description and I will teach you everything about it, of course. Now let's begin with the actual analysis. This is going to be very simple, straightforward, like beginner friendly, straightforward. So grab a piece of paper, grab a pen, write some notes. I will teach you as much as I can, those tips and tricks and so on. So yeah, that's about it. Let's go, okay? Now, generally, as a complete beginner, whenever you analyze stocks, you should care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value, and price. Now here you have some quick facts about Equitrans. It's an oil and gas company that was founded in 2018 and they do gas gathering and distribution and reselling and so on and so on. Now here is already the first thing that you should pay attention to, okay? Let's take a look when the company was founded. So it was founded in 2018. So for me, that's already first red flag, because whenever we invest in the stock market, we want to invest in companies that have those time-proven strategies. And what I mean by that is, if you have a young company, we don't know for sure whether that company has good enough management so that whenever some crisis happen, that they can survive that crisis. You know what I mean? For example, with this company, we don't know for sure if they will survive another, let's say, coronavirus crisis or something, you know? Whereas when we have, for example, Coca-Cola that was founded 200 years ago, then for Coca-Cola, we for sure know that if there is going to be some crisis, that they will be able to manage it, because, or at least they have higher chances of managing it, because it's an older company and they are on the market already for 200 years, okay? They survived the Great Depression, they survived the Black Friday, they survived dot-com bubble, they survived 2008 real estate crash, they survived coronavirus. You know what I mean? They survived already like 5-6 crises. Whereas this company, Equitrans, they were founded maybe how much? 6 years ago. So for them, we don't know if they will survive the next major crisis, okay? They survived coronavirus, so that's already a good sign, but we don't know that for sure, okay? So whenever you invest in stocks, preferably you should invest in companies that are at least from 1950, 1960 and further, okay, further back. So that they are already like 60, 70 years old, that's preferable, okay? So now let's go to the chart. And for chart, we have an instruction that tells us chart has to grow for all 10 years. Now, obviously, this company was founded 6 years ago, so we don't have the data for 10 years. But nonetheless, we are going to analyze whatever we have right now here, okay? So we have 6 years and chart has to grow. What I mean by that is that I will first of all draw a little exponential growing line, kinda like that. And then we will compare the actual stock price chart, which is the orange line, with that black line, okay? And preferably they should follow each other, because that means that the company is growing in the future, like it's growing more and more, you know, it's getting more and more profitable, it's expanding, and so on and so on. You know what I mean? And what do we have here? Here we have exactly the opposite, okay? First, you can see that here in 2020 or 19 at least, the growth was massive, like the stock price was around $20. And then since coronavirus, it fell massively, and now it's slowly catching up. It's very slowly growing, but still we don't have that exponential growth, you know, because obviously the price fell first and now it's slowly growing. So we don't want to see that. We don't want to see that unexpected turn, you know. We want to see like kind of chart growing like this. Let me draw it here on the screen with the purple color. For example, of course it will go up and down, up and down, up and down, but it's growing kind of like that, you know what I mean? Up and down, but growing towards the right top corner, so to say. it's growing, this is what we want. But here we have exactly the opposite. It's that simple. Now we come to the profit, and for profit we also have an instruction that it has to be in plus and it has to grow through the whole 10 years that we analyze. Here the same story, we will analyze the data for all the years that we have, okay? And you can immediately see the red flag, the biggest red flag whenever I analyze stocks, okay? Which is 2017, 2019, 2021 and 2022. What do those years have in common? Exactly, they have losses. They had 4 losses so far. You see 4 out of 5 losses, which is a major red flag for me. Whenever we invest in companies, we want to have profitable businesses, because whenever you buy stock, you are literally buying a business. You need to understand that. So if the business is not profitable, then you are buying some crappy company. I'm sorry to say it that way, but that's the truth. This is a crappy company, okay? Because they have minus. Whenever you have a loss, you don't analyze it further. It's just a no-go, you know, immediately. Because you buy actual business. You become an owner of unprofitable business. You know what I mean? Whenever you buy shares, you become that. So it's a no-go. It's a no-go, really. No-go, no-go. I cannot stress that enough. Now we come to the debt. And for that you have an instruction that it has to be low and it has to preferably decrease through the years, okay? Now here we have exactly the opposite. Here the debt is growing, kinda like that. So again, the debt is not decreasing, it's growing. So of course that's a no-go for sure as well, you know? Probably because it's a startup company, but that doesn't change the fact that they have higher debt, you know? Preferably you make business as cheap as possible, okay? And now we come to the money, and with that money we actually mean the money that they have on their bank account. For example, on their, just like you have 200 euros on your bank account, they have, in this case, let's say 500 or almost 600 million dollars on their bank account, okay? And preferably they should have more money than the costs. Now, why is that important? That's important because whenever something unexpected happens, they have some money that they can cover that unexpected event, okay? For example, let's say they are doing some gas business. Let's say that one oil pump explodes, okay? And they start to lose money because they cannot pump that gas out of the earth, you know, or whatever, you know, they cannot pump the oil. It's that simple. So they can use that money on their bank account to kind of buy either new pump or repair it, or maybe get export the gas from somewhere else and then resell it for higher and get the spread and so on. You know what I mean? They have flexibility because they have the money. They can find a solution much easier and without any stress, okay? This is why it's important to have a positive balance on the bank account. Now, do they have more costs? I mean, do they have more money than the costs? You are smart, use your brain. As I always say, you know, look, they have plus $573 million on their bank account. So yeah, they have almost $500 million, which is a good amount of money in my opinion. So they have money, they can cover something unexpected, okay? And now we come to the valuation, and obviously we want to invest in stocks that are undervalued, okay? And now as a complete beginner, you might not know how to do that. So here are 2 steps that you can do whenever you analyze it, okay? First is called P/E ratio, and the second one is called intrinsic value, okay? Now, as a rule of thumb, bro, you should consider that P/E ratio should always be lower than 15, and intrinsic value should be higher than the current stock price. You can find P/E ratio and intrinsic value on the internet. Just write Equitrans P/E ratio or Equitrans intrinsic value and you find the data. It's that simple, okay? Now let's take a look here. Is current P/E ratio of Equitrans lower than 15? Yes, it is. It's around 14.5, which is slightly lower than 15. So that's a good sign, okay? Company is undervalued in terms of P/E ratio. Now let's come to the intrinsic value. Now this might sound a bit complicated, but please pay attention now, okay? Intrinsic value tells you the price that the company should have at this exact moment, okay? So based on some calculations in the background or some I don't know, balance sheet, income statement and cash flow statement, whatever. Based on those calculations, the current stock price should be $16, okay? But the actual price is 13. You know what I mean? So the price right now is actually for $3 lower than it should have been. Therefore, it's undervalued as well. You know what I mean? Look at the instruction. Intrinsic value should be higher than the current stock price. And intrinsic value is higher than the current stock price. So yes, company is as well undervalued in terms of intrinsic value. So that's a good sign, okay? Basically, intrinsic value, what it should have, and the current stock price is what it has. It's that simple, okay? And now we come to the price. And for price, we have an instruction that it has to be lower than 150 euros. I am from Europe, we use euros. You are from America, you use dollars, okay? So for you, it's the same, $150. It doesn't matter, okay? And at the moment of recording this video, the stock price was almost $13, which is way below 150. So yes, stock is underpriced as well, okay? Because $150 is kind of the border between overpriced and underpriced stock, because you don't want to invest in expensive stocks, especially when you are a beginner with a tight budget. You are a young man, you are trying to hustle, okay? So you don't have $1 million, you have maybe $500, $600. And if you buy, I don't know, some Amazon stock back in the days when it was $1,000, what can you do that? You can just buy one stock and not even the one full stock, you know what I mean? So we want to invest in stocks that are cheap so that we can buy multiple stocks and kind of diversify a bit our portfolio, okay? We can spread the eggs or whatever is that called, you know what I mean? So yeah, now let's come to the final evaluation, where we are just going to summarize basically everything that we found out about the company, okay? Now, is the chart growing? Yes, it is, but the problem is that the price fell massively in 2019, 2020 because of Corona probably, so chart is not good, okay? Now, is the company profitable? Does the profit also grow exponentially just like the chart should? No, it does not. They had 4 losses, so that's immediately a no-go. Immediately, don't even think about it. Is the debt decreasing? No, it's not. It's growing, unfortunately. Do they have money on their bank account? Do they have positive balance? Yes, they do. They have almost $500 million. So that's a good sign. Is the stock undervalued, both with P/E ratio and intrinsic value? Yes, it is. Is the price below $150? Yes, it is. So should you buy or sell? In my opinion, you should sell. Like, for example, when I see the stock that has loss, that's immediately a no-go for me. No matter how good the stock is, no matter how good the company is, if fucking Elon Musk is investing into this company or not, I don't fucking care, okay? If they have loss, that's immediately a no-go. I don't touch this stock, and yeah, that's about it. For me, I wouldn't buy it because it has loss, the chart is not growing, they have too much debt. Look, I can show you also here in more detailed analysis. They have too much debt because retained earnings tell us how much money do they reinvest in the company, right? But the problem is they are paying dividends instead of reinvesting that money back. So if retained earnings here are in minus, that means that their business model is completely unsustainable, it's unprofitable, so it's going to be fucked up in the future for sure. Total equity, which basically means all of the money coming into the company, is decreasing. You know what I mean? They have more costs that they can afford, and it's unsustainable, it's horrible. Debt percent, look, 500 fucking percent debt in comparison to all the money coming in. It's completely unsustainable, it's fucked up, it's fucking fuck, you know? Total revenue is growing, gross profit is growing, operating income is growing, everything is growing, except the fact that they have way too much debt, they have loss, and they are paying way too much money for dividend holders or shareholders, and it's completely unsustainable. So no, in my opinion, I wouldn't buy it, and that's about it, yeah. Now, if you want to know more about stock market investing, you are more than welcome to click the first link in the description. Join me on my journey, click subscribe, let's get rich together with stock market investing. Do the hard work and see you on top of the world.